So before we move on to the alternatives, I wanted to talk briefly about the hybrid model for the development of the guidance that is set out in part 1 of the consultation paper. Some of you may have seen this before as part of the regional roundtables that we did on part 1, but even if so, hopefully a useful reminder. The proposed model that we're looking at for the guidance uses existing international frameworks with support from national frameworks. In this model, IFRS for SMEs is proposed to be the foundational international framework. And this is because IFRS for SMEs is a single standalone set of guidance that is periodically rather than continuously updated. And therefore would provide a stable base for the guidance. But IFRS for SMEs, with its focus on private sector transactions, doesn't address all MPO specific issues. So we're proposing that the full suite of IFRS standards and the full suite of IFRS standards and their conceptual frameworks would also be used where IFRS for SMEs doesn't address an MPO specific issues. And we're also proposing that the model draws on jurisdictional level guidance that has been developed specifically for MPOs in particular jurisdictions. A number of countries have MPO specific guidance that have got well thought through approaches to MPO specific transactions. But depending on the country context, this can lead to differing solutions. So adopting this approach will mean that we can access kind of the appropriate elements of existing guidance without starting from scratch. And the alternatives that we're about to discuss kind of utilise this model to varying degrees, but not all of it, as of course we're looking for feedback on the model itself. So we haven't necessarily presumed that will be what we'll be using. So moving on to the alternatives, we're going to start with kind of looking at the technical aspects of this. So issue paper 3 on non-exchange revenue includes 4 alternatives on the treatment of non-exchange revenue that is based on different international frameworks. And currently international guidance on the recognition and measurement of non-exchange revenue is mainly included in IAS 20, Accounting for Government Grants and Disclosure of Government Assistance, which is part of the IFRS suite of standards. In parallel with that, there is sections 23 and 24 of the IFRS for SMEs standard. And within the IFRS suite of standards, there is a specific standard on revenue from non-exchange transactions that's there. So if I could just sort of talk to some of this. So the International Accounting Standards Board has initiated a programme to review the IFRS SME standard, and in particular to consider updates for standards issued since the last update a number of years ago. And so that might impact the guidance that is currently there. And similarly, IPSASB, the International Public Sector Accounting Standards Board, is also consulting on proposed changes to its revenue standards. And on the slide, you can see reference to ED 70 and 71, which it recently issued. Generally, the guidance provided by the standards is based on the core principle that revenue is recognised when it is probable that an entity will receive the economic benefits associated with the transaction and that it can be reliably estimated. The guidance also requires that an entity has control over the assets. I think these are things that we've talked about in the financial reporting challenges. And as previously mentioned, standards require the initial measurement of revenue to be based on fair value at the date of acquisition, and fair value may be ascertained by reference to an active market or through an appraisal mechanism. And all of the standards require a minimum presentation of incoming resources, with further disclosure, including the disaggregation of significant balances required. For non-exchange transactions, this goes to the nature and type of these transactions. But picking up on a few specifics, within IFRS, it provides guidance on accounting of revenue from government grants. It doesn't specifically cover other types of non-exchange revenue. And the standard provides that revenue from government grants is recognised on a systematic basis over the periods that the entity recognises as expenses the related costs that the grants are intended to compensate. So IAS 20 allows grant revenue provided for capital assets to be recognised over the life of the asset by deferring revenue in the statement of financial position, or by deducting the grant when determining the carrying amount of an asset. So some very specific things related to government grants, but not anything else. On IFRS for SMEs, the standard also only addresses the treatment of government grants, but unlike IAS 20, the IFRS for SME standard requires that a grant that imposes specified future performance requirements is only recognised as revenue as or when performance requirements are met, with an option again to deduct the grant when determining the carrying amount of the asset. The recognition criteria and measurement bases in the IFRS conceptual framework, and the recognition criteria and measurement bases in the relevant sections of the IFRS for SME standard could be applied to non-exchange revenue. So whilst they focused on government grants, they could be applied by analogy. And applying these concepts would in both cases result in revenue and an asset being recognised at fair value when an NPO controls a donated item. So if a condition gives rise to a present obligation for an NPO, a liability rather than revenue may be recognised until the obligation has been satisfied, at which point the liability would be recognised and revenue recognised. So just kind of looking at IFRS, IFRS 23 is, as I said, is a standard specifically for non-exchange transactions, which it describes as those transactions where the entity receives value without directly giving approximately equal value in exchange. And it includes cash transfers. The standard defines conditions and restrictions, which form stipulations, which we talked about earlier. And under IFRS 23, conditions include the situation where the entity is required to return resources to the contributor where conditions are not met. And they call this a use or return requirement in the standard. Where conditions are attached, a liability is recognised being the present obligation that arises because of the conditions. In contrast, restrictions that are stipulations and don't have a use or return requirement have no liability recognised, and revenue is recognised immediately. As I mentioned, IFSASB has recently published exposure drafts that have proposals for non-exchange revenue, that revenue would be recognised when conditions are met. Where cash is received in advance of conditions being satisfied, a liability is recognised until the conditions have been met. So some of the things that we've been talking about, and where conditions are satisfied before the cash is received, an asset will be recognised. Unlike IFRS 23, these proposals do not include a use or return requirement. So it is slightly different to what was before. These ASB proposals explicitly address cash transfers to acquire or construct a capital asset, and it proposes that revenue from cash transfers would be recognised as an asset is either procured or constructed, and not over the useful life of an asset. IFRS 23 also specifically addresses services in kind, It does this by permitting entities to recognise revenue from services in kind, but it doesn't require it. Entities are encouraged to disclose the nature and type of major classes of service in kind received, including those that are not recognised. In the national guidance, the approach taken, it varies. In some national standards, there's been convergence on IFRS standards, some IFRS for SMEs and some IFRS, and some have taken an independent approach, so it is quite variable. And jurisdictions may permit or require exceptions to the general recognition and measurements that typically apply to revenue, and they do this primarily in respect of gifts in kind and services in kind. National standards include a number of provisions not included in various international standards in respect of non-exchange revenue. And while the provisions in each set of national standards are different, some of the key approach include where items have been donated for resale and are impractical to measure, allowing revenue to be recognised when items are sold. It provides for donated items for distributions for the MPO's own use, and allows that when reliable measurement on receipt is impractical, is that a revenue and expense can be recognised when the item is distributed, and another approach is that no revenue or expense is recognised. There are also a couple of different approaches to service in kind. One is that services are only recognised when they would otherwise have been purchased, and another approach is that services in kind are only recognised when they can be reliably measured, and if not, that they're disclosed. There's also an alternative approach for donated items of any sort, that where the revenue, where they're only recognised as revenue when they can be reliably measured and would have been purchased. So some different approaches there. With this backcloth, the four alternatives that I'm now going to go through access both the international and national approaches. The IFRS for SME standard forms the starting point for the first alternative. The IFRS suite of standards forms the starting point for the second alternative, and the remaining two alternatives are based on IFRS. With all of the alternatives, we would look at providing MPO specific guidance. So to the first alternative. So alternative one would require all non-exchange revenue to be recognised in accordance with IFRS for SME standard. This framework provides specific guidance for government grants, as I've just described. And under IFRS for SMEs, government grants are recognised as revenue as or when conditions or performance requirements are satisfied. This may mean that some revenue is deferred. For non-exchange revenue other than government grants, we would look to apply the concepts and pervasive principles in the IFRS for SME standard and apply that to other types of non-exchange revenue. And we think that this is likely to result in a kind of similar accounting outcome to the requirements that are there for government grants. Therefore, for grants for non-government bodies and other contributions, this alternative would adopt a similar approach to the treatment of government grants under IFRS for SMEs. As a result, under this alternative, MPOs would be required to recognise revenue from services in kind and gifts in kind where they can be reliably measured. There would be no exemptions under this alternative, and MPOs would need to maintain records to support this approach. As I said before, additional MPO specific guidance would be provided, which would support the application of standards and recommend disclosures. So on to alternative two. So alternative two is based on IFRS, as I said, and requires non-exchange revenue to be recognised using the principles in IAS 20. So using this alternative, the treatment of government grants would be extended to other non-exchange revenue. This would mean that revenue is recognised on a systematic basis over the period that the MPO recognises the related costs as expenses. As with alternative one, in applying these principles, MPOs would be required to recognise revenue from services in kind and gifts in kind where they can be reliably measured. Again, there would be no exemptions under this alternative, and MPOs would need to maintain records to support its approach. With, of course, additional MPO specific guidance that would support the application of the standards and recommended disclosures. Turning now to alternative three. Alternative three requires non-exchange revenue to be accounted using the principles in IFRS 23. These principles cover the types of revenues that we've been discussing in this webinar. Revenue is usually recognised when an MPO controls the assets, but is deferred where there are conditions. Non-exchange revenue is recognised as conditions and performance requirements are satisfied, and conditions always include a use or return requirement. This means that all gifts in kind would be required to be recognised on receipts, subject to any conditions needing to be satisfied and it being possible to measure them reliably. As I said, under IFRS 23, MPOs are encouraged but not required to recognise services in kind. So this approach therefore provides the potential for an exemption to recognise services in kind. And as with alternatives 1 and 2, there will be additional MPO specific guidance that would support the application of the standards and disclosures. So finally, alternative 4, which I'm describing as a bespoke alternative, but very much based on IFRS. And alternative 4 requires non-exchange to be accounted for using the principles in IFRS, but it also proposes the inclusion of exceptions to be drawn from various national standards that could be included or considered for inclusion as part of MPO specific guidance. So the exceptions could include, we could permit MPOs to recognise from revenue from gifts in kind donated for resale at point of sale rather than point of receipt, where measuring their value is impractical, and that would overcome some of the issues that we've discussed. It could permit MPOs to not recognise inventory or revenue on receipt of gifts in kind donated for distribution, where measuring their value is impractical. Again, that might assist with the issues that we've discussed and obviate any discussions about materiality. It could also permit MPOs to recognise revenue and an expense when items are distributed or used to provide services. And it could also require additional disclosures where an MPO uses one of the permitted exceptions. So this alternative would also permit but not require MPOs to recognise services in kind as revenue and expense. As with alternative 3, non-exchange revenue would be recognised as conditions or performance requirements are satisfied. So this alternative looks to specifically address some of the issues that we've talked about. And what we've set out in the consultation paper to help understand the implication of the alternatives is the relative advantages and disadvantages. And we look at these through 4 different lenses. We look at it from a technical lens, a practical lens, a stakeholder lens, and through cost benefit. And in this slide here, we've summarised the relative advantages that we've identified in the consultation paper. And in looking at the relative advantages of the alternatives for non-exchange revenue, all have the technical advantage of similarity or compliance with existing standards or conceptual frameworks. But with only alternative 3 following a specific standard directly, all of the others are adopting principles in some way, shape or form. From a practical perspective, alternatives 1 and 2 assist by providing guidance to apply the concept in IFRS and IFRS for SMEs. Alternatives 3 and 4, being based on a specific standard, allow a pragmatic approach to services in kind, which we see as a potential advantage. Also, alternative 2 offers an easy to implement approach in IS 20, but we note that this is now quite an old standard within the ISB's suite of standards. So we don't know what the future might hold from that. From a stakeholder perspective, the guidance can assist in providing greater consistency of application. And with alternatives 3 and 4, there would be additional disclosures that could be helpful to stakeholders, with alternative 4 providing further disclosures to meet the needs of stakeholders. Similarly, with similar to the advantages, we've also looked at their disadvantages. And in looking at these relative disadvantages, from a technical perspective, you can get quite different results depending on which international framework is used. Notably, the bespoke approach in alternative 4 could lead to conceptual gaps, depending on how far it departs from the existing framework. So that is a risk. From a practical perspective, all the alternatives, other than alternative 4, have system implications, as information would need to be captured for recognition and measurement purposes. This disadvantage is most notable for inventory items. And in addition, alternative 2 may have practical difficulties for MPOs in making judgments to estimate timing for recognition purposes. From a stakeholder perspective, all of the alternatives other than alternative 4 have the disadvantage of lack of comparability due to choice of accounting policy available in the standards. Alternatives 2 and 4 may also lead to a lack of transparency. Alternative 2 due to the ability to take a net approach, and so the gross position is obscured, and alternative 4 due to the exceptions, although additional disclosure requirements should mitigate this. From a cost benefit perspective, alternatives 1, 2 and 3 may be more expensive, as they do not include exceptions for gifts in kind, particularly for gifts in kind. And with alternative 1 and 2, they don't provide exceptions for services in kind, and so they may be even more costly as a consequence. We have a list of questions in the consultation paper, and they are focused on whether we've got a correct description of the issue, your thoughts on the alternatives, and as part of that. And these questions are all some of the questions are standard to all of the topics, and are intended to provide feedback that will help us progress each issue as we start to develop draft guidance. In this topic, we're also interested in whether you think there should be exceptions for the recognition and measurement of gifts in kind and services in kind. We recognise that this kind of transparency can lead to more work, but we think that this additional effort could be more than offset by benefits, but interested in your views on this about what would add most value. We're also interested in your thoughts about practical considerations. We've frequently heard people talk about the implications for tax or for audit thresholds, depending on what's recognised as revenue. So really interested through the consultation to get thoughts on that.